What's going on, everybody? Today I'm going to be talking about when it makes sense to buy down your rate, given that rates have been coming down over the last couple months as we head into 2024, and how you can do the calculations yourself to see if a buy down when you're making a purchase, buying points, or if a refinance makes sense for you. So behind me, I have an example of a $400,000 loan amount at 6.75%. This is a super realistic figure that we were seeing the last couple of months. Given the interest rate environment, and with that 6.75% and $400,000 loan amount, your estimated payment would be $2,594.39 a month. Now, if we were to drop the interest rate to 5.75%, just for the scenario, the same $400,000 loan, you would save about $260 a month, with your new payment being $2334.39. And so to do the calculations on if a buy down or rate reduction through a refinance makes sense in this scenario, we need to figure out how much it costs in points to buy down the rate from 6.75 to 5.75. And if you don't know what points are increased closing costs paid at closing through the transaction to lower the interest rate lower than what a par or free rate is. So for the sake of this example, let's say that the 5.75% is costing 1.5% of the loan amount. 1.5% of $400,000 would be a $6,000 in points. We then, now knowing that it costs $6,000 in points, need to take the savings of which you had, dropping it from 6.75 to 5.75 of $260, and we're going to take the 6,000 divided by the 260 to give us our number. So we're going to go 6,000 divided by 260, and that's going to be somewhere around 22 months. I'm just doing some rough math, but somewhere around 22 months. So in this scenario, depending on your outlook for interest rates and what you personally think and your goals for the house, anything under 36 months is generally a good deal. And so I would advise that you take a scenario like this if you can come up with the closing costs or have the seller pay it or wrap it into the loan with a refinance, because the math makes sense. We're at 22 months of recoupment. Hopefully now 100% makes sense on how you get the basic recoupment calculation on if a discount point that you're paying makes sense in your scenario. Let's dive in a little bit further. There are going to be quite a few refinances, and there's already people hitting me up about refinancing their interest rates that they obtained in 2023. And so let's take a step further so that way you guys have all the knowledge needed to make a smart financial refinance decision. So with the basic numbers here, we're saving $260 a month, right? But we have to keep in mind the closing costs that it takes to complete a refinance transaction, and where are those closing costs going to come from? More often than not, closing costs for a refinance are actually wrapped into your loan amount. And for that, the loan amount is going to increase depending on the loan to value limits that are allowable for your loan. Let's take a loan at $400,000 again as an example, and let's just say that closing costs are $10,000. Closing costs are going to, include any lender fees if there are any associated. We personally don't have any, so long as you are a past client. There's going to be the discount points, like the $6,000 example that we had earlier, and then there's going to be title and escrow fees, but because we still have to close and record the transaction with county. So with $10,000, just for ease of math, let's rerun these numbers and see where it takes us. So instead of the $400,000 loan, now you're going to have a $410,000 loan. And instead of the $2,594 a month, we're probably going to have a payment about $2,400 a month. A good rule of thumb is every $5,000 added to the loan amount increases the payment $35 a month. We're being a bit more conservative. We're adding about $70 a month here, just to give a good general idea. So now, instead of saving $260 a month, we are saving about $194 a month. And we need to see if it still makes sense. The rate is still costing $6,000 like in our previous example. And so we're going to take the $6,000 in this scenario and divide that by the savings of $194. This is going to be an increased recoupment, and it's going to take you longer to make money on your investment. It's going to be a little bit over 30 months but we're still under that 36-month threshold where it makes sense. Another thing to keep in mind with refinances, yes, there are closing costs involved, and anyone saying otherwise is either giving you a massive credit or they're just not explaining fully that title and escrow potential appraisals are involved in items like that. But with a refinance, you generally will skip 1, sometimes 2 mortgage payments and receive a refund of your current escrow account about 45 days after closing. So if you were to close this in the first part of February in 2024, you would actually skip your February 2024 payment, your March payment, and your first payment would be in April. And so if your payments, were about $2,600, skipping 2 of those already is $5,200 plus a refund of your escrow account because we are resetting up escrow in the transaction. It just about washes out the closing costs that you are adding to the loan amount. And the smart person would pocket that money and apply it towards principal so that way they can jumpstart their new loan into the new year.